Here is the puzzle sitting on every trading desk this morning, Thursday the 30th of July, 2026. The Federal Reserve did nothing yesterday. It left interest rates exactly where they were. And Bitcoin went up. Gold went up too. On the surface that looks like a market breathing a sigh of relief. But read the analyst notes published overnight and you will struggle to find a single one calling that decision friendly. CoinDesk's roundup this morning found near unanimous agreement on one point: the hold was hawkish. Where the agreement collapses completely is on what happens next. Some see the beginning of a fresh leg higher. Others say the rally you saw yesterday is precisely the kind of move that traps late buyers. In the next few minutes we will unpack what the Fed actually did, why 3 dissenting votes matter more than the headline, and what the evidence says about where Bitcoin goes from here. Let us start with the facts rather than the interpretation. The Federal Open Market Committee met and voted to hold interest rates steady. The vote was 9-3. That is the number professionals fixated on, because 3 dissents at a single meeting is unusual by modern Federal Reserve standards. For most of the past 2 decades the committee has prized the appearance of consensus, and chairs have worked hard to keep dissent down to one voice, sometimes none at all. 3 people breaking ranks tells you the internal debate is genuinely unresolved. CNBC framed it simply as a divided Fed, and asked what that division means for investors. It is worth remembering this was flagged in advance. Back on the 9th of July, coverage of the committee's own projections showed officials scattered across a wide range of views on where rates should sit in the years ahead. Yesterday's vote did not create the split. It confirmed it. This is the part that confuses newer investors, so let us be precise. A hold is not automatically hawkish. It becomes hawkish when it is more restrictive than what markets had already priced in. Traders do not react to the decision. They react to the gap between the decision and their expectations. Heading into this meeting, a meaningful slice of the market was positioned for signals of easing ahead, and did not get them. When the accompanying language leans on patience and on inflation risk rather than on growth risk, the effective message is that money stays expensive for longer than hoped. That matters enormously for Bitcoin, because Bitcoin is priced at the far end of the risk curve. Higher for longer rates mean a stronger dollar, tighter liquidity, and a higher hurdle rate for every speculative asset. That is the mechanical channel through which a boring central bank meeting moves a crypto chart. There is a second layer here that did not exist a year ago. The chair of the Federal Reserve is no longer Jerome Powell. Kevin Warsh now leads the committee, and that handover has been one of the defining macro stories of 2026. Coverage in early June described markets repricing essentially everything in response, because Warsh arrived with a long-standing reputation as an inflation hawk skeptical of loose policy. His first FOMC test came in mid-June, and the block noted at the time that Bitcoin was holding below $65,000 going into it, with additional pressure coming from concerns around Strategy, the largest corporate Bitcoin holder. So yesterday was not an isolated event. It was the second data point in a new regime. Analysts are still calibrating how much of the hawkishness is Warsh's personality and how much is genuine economic data, and that uncertainty is a real part of why forecasts diverge so widely right now. Now to what actually happened in prices. Being Crypto reported that both Bitcoin and gold jumped after the hold and the 9-3 split. That combination is the detail worth pausing on. Gold and Bitcoin rising together, on a day when the central bank sounded restrictive, is not a classic risk-on move. It reads more like a hedge against institutional uncertainty. When a rate-setting committee visibly fractures, some capital rotates into assets that sit outside the policy framework entirely. That is the debasement trade, and it explains why hard money assets can rally on a hawkish headline. The counterpoint is timing. Just a day earlier, on the 28th of July, technical analysts were arguing that Bitcoin's bounce towards $67,000 was a bull trap and that more pain was likely before the Fed decision. Yesterday's move did not resolve that argument. It simply raised the stakes on it. So what are the two camps actually saying? The constructive case runs like this. A divided committee with 3 dissents is a committee closer to changing course than a unanimous one. Every hawkish hold pulls forward the moment when the data forces a pivot, and Bitcoin has historically front-run that pivot rather than waiting for it. Add the gold correlation and you have a story about monetary credibility that does not depend on a rate cut at all. The bearish case is more mechanical. Bitcoin has spent much of this summer struggling around and below the $65,000 area. Rallies into resistance that fail have a habit of producing lower highs, and a single day of post-meeting strength is not a trend. Until liquidity conditions actually loosen, this camp argues, every bounce is supply looking for an exit. Both readings are defensible from the same set of facts. Rather than guess at a price, focus on the signals that will settle the argument. First, the levels. Whether Bitcoin can hold above the $65,000 to $67,000 zone in the sessions ahead is the single cleanest test of whether the bull trap thesis was right. Reclaiming it and holding it invalidates the bearish red. Losing it quickly confirms it. Second, the minutes of yesterday's meeting, which will be published in roughly 3 weeks and will reveal how close those 3 dissenters came to swinging the vote. Third, the incoming inflation and labor data, because in a divided committee each release carries more weight than usual. Fourth, the dollar. Sustained dollar strength has consistently capped crypto rallies through this cycle. If you track just those 4 things over the next fortnight, you will be ahead of most commentary. Here's what to carry away from Thursday the 30th of July, 2026. The Fed held rates in a 9-3 vote, the tone was read as hawkish across the board, and Bitcoin and gold both rose anyway. That apparent contradiction is the whole story. Markets are not trading the rate decision, they are trading the credibility of a committee that can no longer agree with itself, under a new chair whose reaction function is still being learned. When analysts unanimously agree on the diagnosis but split on the prognosis, that is a signal about uncertainty, not direction, and the sensible response is to size positions accordingly rather than to pick a side loudly. Watch the levels, watch the minutes, watch the dollar. The next few weeks will settle an argument that yesterday's meeting only sharpened. Thank you for watching, and do subscribe for daily macro coverage.